if you look at interest rates, again, going back, you said near zero. No, actually, when you look at real interest rates, they're negative. They're deeply negative. And, quite frankly, if 30 years ago you told me when I entered these markets, or a little bit longer, you saw 18% treasuries or 20% interest rates, if you told me that there'd be trillions of dollars in negative interest rate yielding bonds, I'd have you put in a straitjacket and taken away to a mental institution. There's no way anyone would ever believe that would be possible. So this is where we've come. So it's a complete monetary insanity, but it will come back to haunt people in terms of hyperinflation, I think.
Do you think that? Because everyone always uses the parallel of Weimar Germany. Do you think that's really the case?
Well, I think that it has to happen eventually, because it's just a matter of a time series. I mean, as we discussed in the opening part of the show, you went from 1 billion in bailouts now to hundreds of trillions in 20 years, a little over 20 years. So eventually you're going to hit the end of the road, and US dollar hegemony is going to be what suffers this eventually, because somebody, I don't know if it's going to be China, Russia, or a combination of other countries, is going to come out with a currency linked to hard assets like oil, copper, silver, gold, and exchangeable, fungible for something. Because right now, a currency is a promise of a government to repay its debt. So the US dollar is the reserve currency of the world. It's been for a little over 100 years, before that sterling for 400 years. But when people realize the United States cannot pay back its debt, then obviously people will lose faith in it. And if another country like China says we're going to have a gold-backed yuan, then that's going to be the dominant currency. So I see that as happening. It can happen overnight, and that will cause a massive problem. And we already have hyperinflation in selected asset classes. I mean, look at the exponential increase in housing prices when, if you inflation adjust for real wages back to 1980, we're flat to lower. So there's got to be a correlation to earnings and house prices. And when those markets become untethered to each other, you're ripe for a disaster.